Hi, my name is Stuart and welcome to the Invest Properly podcast. My goal is to share easy to understand, evidence-based, holistic insights to help you master the game of building wealth. And in this episode, I'd like to talk about what is a strategic asset allocation and why it matters. Now, no one can control markets. No one can guarantee investment returns. In a way, we are complete passengers on that investment journey. However, we can control where we choose to invest our money. So in terms of which geographical markets, which asset classes, which sub-asset classes, all those sorts of things. And those are very important decisions. And they're really referred to as asset allocation decisions, whether that's strategic asset allocation, dynamic asset allocation, or a tactical asset allocation, all three of those sort of approaches. And so what I wanted to do in this episode is share our firm's approach to asset allocation decisions. Because as I said, that's the one decision that we can control is if we've got money today, where do we invest that money? And in 10 years from now, our position, what we have experienced in terms of returns and our financial position will be a direct result of the quality of the decision that we make today in terms of asset allocation. Because again, we've got complete control over that. We can't control markets. So that's why I thought it'd be interesting to share our approach to that. So a gentleman called Bernard Melke wrote a book called in the mid-70s, Random Walk Down Wall Street, which I think I've mentioned before here in this podcast. But the thesis behind the book was that returns are random. No one really knows which asset class is going to produce the best return over the next 12 months or maybe even next 3 years is difficult to predict. However, longer term trends are a little bit easier to predict because, we can rely on the theory of mean reversion. And plus also in the long run, it's really the fundamentals come into play rather than, what might be popular over the next 6 months, which is really, whatever's going to be popular over the next 6 months is probably going to drive the returns over the next 12 months. And I have a chart that I've updated that I've shared before as well on the blog and the website, which shows asset class returns from 1993 onwards. And that's really the time period just mirrors when super began because that's, we've all been forced to be long-term investors in the share market via superannuation since 1993. So we've got 30 years of data now and it's color-coded and sorted from high to low in each year. And the theme is that there's no patterns, that returns are completely random and no one has ever developed a reliable strategy that's going to reliably predict which asset class is going to produce the best returns in the short run. So we have to therefore make investment decisions based on the premise that we don't know, that no one really knows what's going to outperform. But as I said previously, longer term returns are a lot easier to predict, I think. And the data shows that in terms of the correlation between, what the indicators are suggesting the subsequent or future 10-year returns will be and what they have actually subsequently been compared to that projection point. And there's a 70-80% correlation rate in a lot of these key metrics. Therefore, the evidence suggests that, well, I can predict what will happen over the next 10 years, but I can't predict what's going to happen over the next 10 months. And really, that's mainly a lot to do with mean reversion. So, for example, if I'm investing in a sub-asset class that has underperformed over the last 10 years, let's say emerging markets, for instance, and if you compare those emerging markets where they're priced in terms of PE ratios, price to sales ratios, all those sorts of generally accepted metrics, and they look cheap relative to history, well, all the evidence suggests that if I invest today, there's a very high probability that my returns over the next 10 years will be above average because, of course, it needs to revert to the mean. So therefore, you could take that approach with asset allocation. That is, what you could do is put all your money into the markets that look undervalued, that are compellingly undervalued. So not just undervalued for the last 3 months, but say have had really poor performance for say 5 or more years. And so you could put all your money into those markets. Now, the problem with that approach, or what we need to anticipate with that approach, is that you could be wrong. Your timing might not be perfect. And in fact, you could invest all your money in those markets and those markets could continue to underperform. So let me give you an example. Between 2001 and 2010, the US market posted an average decline of 4.6%. So there's nearly a negative 5% return over that 9-year period. Now, its historical average returns close to around 10%. So we're looking 15% sort of below par, below what we would consider normal. So it's no surprise then that between 2011 and 2023, the market surged, returning nearly 16% over that relatively long time period, 12 years. Now, you could have invested in the US market in 2006, and the following 5-year slump, you would have lost about 20% of your initial investment. Remember, the market was negative between '01 and 2010. You were sort of 4 years or 5 years too early by investing in 2006, and you would have lost money. However, if you would have hung on to that investment, your return from your initial investment to 2023 would be close to 10% per annum. So it's sort of bang on the average. So I guess what I'm saying, if you employ an approach that allows you to invest in markets or sub-asset classes that look like they're primed to provide above average returns, it is possible in the shorter term you'll underperform because you can't get the timing perfectly right. You don't know when the market's going to turn. However, the longer you hold that investment, the better off you'll be, as I used in that most recent example. And I would argue that your risk is lower as well, because if you're investing in markets that are already undervalued and then the share market crashes, well, the undervalued investments aren't going to lose as much value as the overvalued investments, right? So therefore, your portfolio is going to have less volatility if everything you've bought or invested in is cheap by today's standards. So what I'm saying is that if your aim is to maximize longer term returns, you've kind of got to make friends with underperforming in the shorter term in order to achieve that. Now, I'm not saying that's going to be the consequence of that decision, but you've got to make friends with being comfortable with that. I'm comfortable that I'm underweight US technology because US technology looks overvalued to me. You know, you've got to make friends with that, and you'd say, yes, I'm comfortable with that because one, it's a lower risk, and two, I think everything's going to revert to the mean, and in 10, 15, 20 years time, when I actually need the balance, whether it's super or whatever it might be, I'm going to be miles in front. Now, that's our idea, that's our thesis and philosophy when we invest new money, but not all funds employ the same approach. In fact, you know, some funds are worried about short-term underperformance. You know, it means a lot. You know, if you underperform, you lose money, and that's how they generate fees, by attracting money, whether you're an industry super fund or, you know, whether you're a managed investment. So there's a lot of pressure on these funds to really track the market as close as possible and make sure that they're trying to beat their peers each and every year, which can promote short-termism. You know, that it can mean that, you know, if you go and invest in that fund, they're going to put some more money in technology because it's really running hard. And if they make a decision not to go into technology, they're going to be punished, both from a returns perspective, but most importantly from a business perspective. And that could cause some really adverse situations on their profitability. Whereas we think, you know, if we're investing new capital like super contributions, why would you invest it in an asset class that's overvalued? Surely, particularly if it's super and you're say 10, 20, 30 years away from retirement, surely you want to put it in those geographical markets that exhibit the greatest potential to deliver above average returns. Why would you want to spread it equally across the market? Doesn't make sense to us. Now, another consequence of this decision is you might end up with a not perfectly balanced portfolio. So for instance, 3 to 4 years ago, we allocated quite a large portion of international exposure into the UK market because at that time, the UK market was quite undervalued. It's still undervalued, but to a lesser extent. But as a result of that, a lot of our clients were overweight the UK market. Now, 3 to 4 years down the track, the UK market has been the best performing developed market to date, only by a slight margin. You know, the US market has done well, so it's only just slightly less. But the UK market had a higher dividend yield. When we were investing in it, it was delivering 4.5%. Now, it's not doing that today because values have risen, but it really reduced the risk because we were investing in, one, a market that was cheap, two, a market that was going to give us 4.5% dividend yield. So we're going to bank some income along the way. And then three, a market that's probably going to revert to the mean, and that's kind of begun. So to employ that approach, you've got to be comfortable with having unbalanced, let's call it an unbalanced asset allocation. Again, that's a critical decision about where you're investing your money. And similarly, other financial planning firms I know really take a very templated approach to managing portfolios. Often they're called model portfolios, which means that the firm comes up with, you know, where they want portfolios to be in terms of allocation, and every month they'll adjust everyone's portfolio. They'll use software to do it to everyone's portfolio, so everyone's portfolio looks the same. Or they might have 3 or 4 different model portfolios depending on risk profile or something like that. We think that templated approach really gives up a lot of value, a lot of long-term value. Might not do much in the short term, but a lot of long-term value. Because to my mind, why would I, you know, sell out of an underperforming market, a cheap market if you like, and put more into the US market just because the US market's had a greater performance and now represents a greater share of the whole? You know, that just doesn't make sense to me and carries risk. Instead, we like to look at each portfolio separately and go, okay, we're going to invest new money today. Where would I want to put it? I need to ask myself 10 years from now, now, looking back, where is the most likely market that has the highest probability of outperforming? To take a template approach and say, look, let's put 20% in the US market, let's put 10% in Europe, let's put 7% in Japan, for example. Taking that kind of template approach is, to my mind, is dumb, because it just doesn't allow you to benefit from, one, the evidence, and two, what you really can control, which is asset allocation decisions. Now, it takes more time in order to do that. One of the attractions to have a sort of template strategy or template solution is that it's very time efficient to have everyone under a uniform asset allocation. So it does take more time. And other people would say, well, we're reducing our business risk. We have, everyone adopting the same asset allocation. No one's out of kilter. So I acknowledge that those positive attributes, mainly in favor of the financial planning firm rather than the clients. But I think our job is really to do the best thing by our clients and really make the best decisions. And if it's my money, I'm going to be thinking about where can I best allocate that money. So I can summarize our asset allocation philosophy really in 3 points. The first step is identify the asset classes or geographical markets that exhibit the best opportunities for providing above average returns. Second step is employ evidence-based strategies such as rules-based low-cost indexing to access those markets, get broad-based access to those markets. And then lastly, sit with it, maintain a long-term perspective, resist the urge to sell investments if they're underperforming, realize that it can take time sometimes, like the example I gave you, 5 years of underperformance eventually came good just because of that mean reversion. We don't know when it's going to happen, but we can at least have the patience to follow the proven evidence-based strategy. So there you go. That's our approach to asset allocation. If you want to learn more, I'm posting a lot of YouTubes on videos, so there's a link in the show notes if you spend any time on YouTube. Certainly check that out. And until next week, bye for now.